So when you were at Baylor, that was originally when you started Campus Grades, right? That was the idea, or was it in high school?
Yeah, it was college. So yeah, a little backstory, right? So started in Baylor. This was 2014, from the Dallas area. It was sophomore year, like that fall. Another fraternity brother of ours. For those of you guys that don't know me, like Wesley's one of my fraternity brothers, one of my good friends in college, and kind of post-college, one of the guys that I've kept up with. And we started it sophomore year. We actually were just looking at, okay, let's enter this new venture competition. Wasn't actually even my idea. So Ryan Robinson, my other partner at the time, it was his idea. He said, hey, I think you're the perfect person to start this business with. What do you think of this idea, this business plan? He just typed up, 3 pages. And I was like, hey, man, let's do this. Let's make some money. So a little bit about Campus Crates. We student storage, moving, shipping, just started with kind of 2 guys in a truck, right? So, we'll pick up your stuff, store it for the summer, and then give you free boxes, deliver it. And we started it up. We just started calling people. I can talk more about, how we started and about the business. But man, it was a grind. That was sophomore year of my college. Yeah.
So y'all identified a need that there were people who, when summer would hit, there was a need for storing your things for people because Baylor has a lot of people from out of state.
Yeah, right? Out of state international people is like, what do you do, especially like freshmen, because almost everybody lived in dorms, right? So how do you kind of move out quickly, right after your final exams? You're stressed, you're studying. What do you do? And then you're going to be gone for 3-4 months, right? And so yeah, we looked at that kind of experience that we had as a freshman student moving out of the dorms. My other partner, he was from out of state. I was in state, and it was still tough. And so we said, hey, we can do this. So we just built a website, we built marketing materials, and we just started creating. We didn't even really borrow any money. We just kind of put in $1,000-$1,500 each and just ran with it.
So one of the things, this is obviously a real estate podcast, but what real estate, you're really building a business. It's very similar, but you are somebody who's built multiple businesses, and that's why we're really starting from the beginning. But I think I have a lot of realtors on the episode. I have a lot of lenders. Really anything that touches real estate. As an investor myself, one of the areas I need to get to from an investment standpoint is learning how to fundraise for these deals, which you throughout your entrepreneurship journey, you've been very successful at that. So I want to hit on that later, but yeah, I want to go back even further. What point in your life did you figure out did you get that entrepreneurship bug?
For sure. Yeah, I mean, I was always growing up selling. I was always, trying to start something, look for opportunities, whether it was selling, snacks and candy in my 3rd grade class, seashells on the beach, whether I was selling textbooks, gum in middle school, you name it, right? Just kind of looking for opportunities. My dad was an entrepreneur, had a lot of kind of figures in my life, whether it was a couple of uncles of mine, people I looked up to that were entrepreneurs, right? And I just found that, it suited my personality well. And so I always knew I wanted to start something. I didn't know it was going to start in college, and I didn't know it was going to be a successful first business, relatively successful. And so very fortunate the first one was because, people get discouraged when their first thing doesn't work out, and it's just, not every business succeeds, right? Mm-hmm. And so I think just by doing things early on, you can see what works, you just get more confident, and that's a huge win. But just always wanting to be an entrepreneur, right? And then even now, I mean, I've been in consulting for almost 7 years, but I've always considered myself, an entrepreneur, whether it's, fundraising for some of these real estate deals and other things. I think you can do stuff on the side, like how you kind of started with the real estate, right? I mean, I think that's a great way for a lot of entrepreneurs to start because you're not putting all your eggs in one basket. But at the same time, looking back on Campus Crates, at least, had I gone all in, right? Had I, not gotten a corporate job right out of school, I feel like I could have, tripled or quadrupled the size of the business whenever I did exit, right? So it was moderately successful, but at the same time, if I was, all in those 3 or so years post-college, when I was doing it on the side, I think we could have grown a lot more.
So why did you decide not to do that?
Yeah, I think for me, I was getting married shortly after school. I was always the type of entrepreneur that tried to balance risk, right? That's a huge part, right? I mean, it's not always been my money. I've always tried to hedge with, investors that also have great experience, that you kind of have that wisdom of having partners. And I can talk more about partnership because I've been really big on that for all the different business ventures. But in terms of, that first, decision of, okay, do I do consulting? I didn't necessarily know that Campus Creates was going to be as successful as it was scaling. We kind of ran into COVID as I was trying to scale. One of those first years out of school, I said, hey, let me do this job. It's a seasonal business. I'll do it on the side, hire kids. I was kind of doing that entrepreneurial mentorship piece. That's how I really grew it. And I just, thought I could juggle it. My life sucked those busy seasons. I mean, that was really tough, but I think I just didn't know I was going to be as successful as it turned out to be.
What was, for somebody that wants to start a business in college, what does it take, in your opinion? And do you recommend, there are a lot of guys out there that say, if you're going to start a business, there's no reason to even go to college. So what would you say to that?
Yeah, a couple of my business partners, they didn't go to college. They did that route, and I think it's not for everyone. I think you get a huge network by going to college, right? Even if you study something that doesn't actually end up being your career. The same thing goes for when I went to business school, right? I went for 1 year, grew my network a ton, learned a ton, kind of focused in on, certain areas that I really wanted to, focus, which was including real estate entrepreneurship. And look what I've done the last 2 years, right? Is, leverage that experience. You don't get that from just kind of reading Twitter. I mean, you can get a lot of good insight, but by just being around people, developing those relationships, I think college is a great place to start because doors just open. And you've got something that's your focus for 3-4 years, right? 5 years for some, right? It allows you to like grow it over time and not feel like, oh, I've got to be paying the bills. I got to be successful on day one starting this business, right? So a couple different thoughts there, but yeah.
So when you graduated, you were still working. You hadn't sold Campus Creates yet, right?
Yeah,
At what point did you end up selling it? A few years after college?
Yeah, so I think one way I was able to really do that was that I did in Campus Creates, after the second summer. I'd already, bought out my previous partner that I mentioned earlier. He was kind of, off pursuing other business ventures. So I ended up partnering with the UPS stores in the Waco area. They had, 10 stores in Texas, 3 guys and their wives. It was just a really great fit. We kind of had a 50-50 partnership. They got a contract with Baylor. We were actually competitors. And so it kind of gave us a bit more, credibility by kind of putting that UPS store kind of partnership name. It gave us a storefront to really be able to scale quickly. Got a warehouse, got a truck, right? Got assets, right? Had access to a lot of Waco relationships, Fort Worth relationships, et cetera. So I kind of used that to give myself a little bit more of a Waco stability, so I could grow in the other markets. So for about 2-3 years after college, I was still growing it, part-time, working nights and weekends while working my day job.
Because you took it from Waco to TCU, right? TCU
was our next contract. That one really, really blew up, and we got approved vendor, and I mean they almost got it as big as Baylor. It took a little longer because COVID hit, and when COVID hit, I thought our business was done. I mean, I thought, okay, well, that was fun, but it ended up actually being like a 5x year for us. We're doing kind of a pack store ship model. We basically packed up kids' rooms when COVID hit. They couldn't get there. We moved 1,000 kids in 3 days. Manning people I had a 20-person UPS team. We were wearing I don't even know if we were wearing masks. This is March 2020, and I was just take off a couple of days from work and go in and do the part-time business. So
you were doing all this while working.
Yeah.
For your job.
Yeah.
Wow.
Yeah, this is all for kids, right? Got all that, and then fast forward a little bit because I know we want to talk about more of the recent stuff in real estate. But when I went to business school, this is about 3-4 years into kind of my career. I got approached by a investment bank to purchase Campus Creates on behalf of a strategic buyer. So the company that ended up buying it was called PackRat. They're owned by 1-800 Pack Rat, and the company that they're like portfolio company was called Storage Squad.
Okay.
And so they kind of rolled us up. We had about a 6-month transition service agreement that I kept on with them. It was actually while I was still in school. So I spent a lot of my 1 year in MBA selling the business and then kind of ultimately like handing it over to be successful.
And are they still operating?
Still operating. Yeah. They're I wouldn't say nationwide. They're more East Coast based. And so they kind of used it to really get into the Texas market. I did also consider another buyer in the time. I tried to, really have more than one option, right? It's always good to be able to negotiate. And so I did consider another company that's now been going nationwide, kind of keep up with them too. It's a very small industry, so I never thought we'd have that good of an exit. Obviously not life-changing money, but like enough to be able to be, ready for the next businesses and kind of focus on my family and stuff.
Why'd you decide to, because it seems like, it was growing, like you had hit TCU. I think, I'm sure you had another.
Austin, yeah.
Were you at UT?
We were at UT and St. Edwards. We got a contract kind of that year as well. So I was just able to show the growth. Like it was a good time, honestly, to get out. It was like 21 going into 2022, which, gangbusters year.
Instead of just going all in on that, why'd you decide to sell it?
Yeah, it kind of reached the point where it was too big for me to continue working full time, right? And I got my MBA sponsored from my consulting firm, and it was kind of at a strategic like impasse of like, okay, do I go all in like you're saying, or do I just take my chips back and like bet on other things? And that's ultimately what I decided to do. I think part of it was also, I was working with college kids. It was a college business, and I had a lot of really great people that were working for me. And I loved that part of it, but I just knew that this next phase of life, I was wanting to focus on family. We got pregnant right after business school. So it was just, good timing, honestly, because I think it'd be really hard to be, changing diapers of a toddler and then running off with college kids, right? It was good timing. So
yeah. Okay. All right. So you sold it. Took a few years where you were just really working W-2, and then now you've got some more ventures currently. This is where this really ties into the real estate standpoint. So a little bit, I want to, before we get there, so your next ventures have been much bigger, and so it's taken some investing, some fundraising.
Yeah.
And so this is where I really am interested in, because I'm at a point, like I hit on earlier, where like I've got to be able to find investors for flips and rentals. I'm at a point where just the banks, in order for me to scale, I have to do that. I can't continue to just do one at a time for me. So investing and fundraising is really important. And I think there's a lot of people listening to this who also do flips and rental properties and Airbnbs. And they also want to know, okay, how do I find better, how do I find money with terms that are more favorable? How do I find, or even, it doesn't necessarily have to be more favorable. It could just be people, so I just don't have to deal with the banks. And pay those origination fees and pay that interest.
Yeah, private lending.
So, right. And we call that private money. This is, in the real estate field, it's different than hard money. Hard money and bank money is really actual lenders, but and private money is people. And we all know people. We've all got that uncle who's done well, or the grandparents, and so you've had to go out there and source money for the businesses that you've created. So talk about like how have you successfully done that, and what does that look like?
Yeah, no, I think you're talking about something that's great for everybody, right? You got to get started somewhere. Your first deal, ideally your house hacking or something, right? Or for us, like we converted our, first townhouse to be kind of a rental, right? And that got us kind of interested. But the market had kind of already started to change, where it's like you really got to be, all in. You can't just buy a house, anymore. Like you got to add value, right? Like, the type of stuff you're doing now to differentiate Airbnbs and stuff, right? So I think for me, in the context of entrepreneurship, right? My first business, it was profitable like right away, right? It was a, 40% margin kind of business, right? So it didn't take a lot of investment to be successful, but some of these bigger real estate projects or some of these, larger types of operating businesses, you do need, investors, right? And you don't want to necessarily bet your whole 401k if you're, exiting the corporate world to get started, right? So it makes sense. Debt's cheaper than equity in the long run. But in terms of getting started, a bank or wherever is not going to give you everything. You got to have equity in, right? And you might not have enough money to just, start something on your own, right? So for me, my mindset is, okay, people believe in me. Like, I feel like I have a decent track record. How do I, extrapolate that to, hey, do you want to be a part of this next thing, right? So it always starts with like having a good brand, right? Having people that trust you, right? It's all a relationship thing, right? No one's just going to cut you a check for $50,000 just because you got a nice pitch deck, right? Just because you found a good property, right? I mean, for Wesley, for your different ventures you've pursued, I mean, I feel like really good at sourcing deals, right? And now you're like, okay, how do I go and multiply this like you're talking about, right? Because you can find more deals than just one, right? But you got to have money for that. And so I think what you've started to do is you've created a track record. So in your instance, now it's just like, okay, if you take a step back for a second and say, how do I, create a fund, or how do I, team up with someone that is also helping me fundraise, right? If you're the deal, you're the real estate person, but you need someone that's, a deal guy or the fundraising guy or girl, right? So for me, with the two ventures that I'm doing right now, one was a lot easier to kind of start because I just went to my old business partners, right? We already had a good history together.
Campus Greats?
From Campus Greats, those UPS guys. And I just said, hey, I've been reflecting. I've found something that I think is a good investment. Let's run and do it. We can talk a little bit more about, how that went into being. But the second venture, on that one, I'm not the operator, right? It's a dog boarding company. My business partner has been doing this for about 7 years before. And so we had him kind of, okay, you're obviously the one that's going to operate it, but he doesn't know necessarily how to start a business. And so I was complimentary in that, aspect of like, hey, I don't know how to run a dog boarding place, but I do know how to run a service business, how to, find real estate. I was starting to kind of figure that out. But we still need something else, right? So we went and found another partner who has actual real estate construction experience because we're doing this ground up. I can talk more about that. But, when we had those three partners, what we did is we said, okay, well, we can put in, between the three of us, $100,000, okay? But that's not going to get you, a $3.5 million property, right? Because we didn't want to lease something.
Right.
So we obviously need quite a bit more equity. So we're doing SBA financing.
Which is small business loans,
yeah,
right?
Yeah, very, very good rates, very good. There's a lot of changes happening in that right now with just kind of the government. They've kind of cracked down because they haven't been super profitable. They started to actually lose money, the SBA program. So it's getting a little more challenging to go buy a business or do real estate deals with, less money down and stuff. Like you need 10 to 15%. Like it's not crazy.
Right.
So what we're doing, it has to be owner occupied. That you can't just go do a typical real estate deal with SBA financing, right? You can't like making it buy an investment property, right? So just I know for a lot of your followers that are interested in real estate, it's got to be owner occupied. So for us, for the commercial deal, it is possible.
Okay.
We'll be the tenant.
Let me slow down. So So what you're saying is you have a business idea that could be yours is specifically dog grooming, but it could be a donut shop. It could be whatever that is. But you have to have a building to operate in, and that's where the real estate. It's a great opportunity. You could take advantage of the SBA loan. To build, and now you own a commercial property, and it just so happens that your business resides in it.
Correct. Yeah. Right? To do, there's different types of SBA loans, and you can do where you're just buying a business or starting a business, but then you can also do an SBA loan, which is for a much longer 25-year note or so, for higher dollar amounts up to $5.5 million, and you can do the real estate with it. It just has to be owner occupied, which is what we're talking about.
So that loan will cover the building. What does it require?
The land, now? Yeah. I mean, we're putting in 15%.
So 15%, which is normal for a construction loan, and it'll cover some of the operating.
Yeah, our operating startup costs. They'll give you working capital too, right? So like we're going to be borrowing close to $3 million to start this first one. We've got 7 or 8 investors.
So you found 7 or 8 investors. I'm sorry to cut. I just want to make sure.
No, you're good because we kind of got. You can go a lot of different ways on this deal. Yeah.
Yeah, but that's kind of what I'm getting at. So it's the same thing with flipping a residential property. Like you had to find whatever the amount is that you needed down. You and your business partners couldn't cover that yourself. Mm-hmm. You needed to raise more money. Mm-hmm. It's very similar to what I'm trying to do, just not to that scale.
Yep.
So you started with you said 3 partners.
Yeah, the 3 of us are all like the general partners. Like we own the majority of the equity, at least on the operating side. We did a kind of a split operating company and a real estate company. But yeah, I think before you even get to those investors, you got to have a good idea, right? You got to find a problem, kind of same thing we were talking about earlier. And what we did was we said, okay, we want to start a dog boarding, grooming, daycare business, and this is where we want to start it. We found a good property location. We found, complementary partners. We created a pitch deck. We created a model. We found a lender, and then we went to investors. So I think you do have to, in most cases, have a good idea, right? Before you just go and have a track record before you go and find those investors.
So what were the 2 different, if you want to get into this is, why did you do 2 different businesses? So you did a real estate business and you did the dog grooming business. Like, why did you separate it like that?
Yeah, I don't know if the SBA mandates it, but for us, we were just trying to separate, what the equity looked like on both. We did require that our investors invest in both. We had a $50,000 minimum between the 2 companies. I think everyone was, and sometimes people invested $100,000. We raised $500,000 total.
Okay.
Right. So, minimum investment $50,000. So if you put 25 in the operating company, 25 in the property company.
Property company is just that's the 15% down to purchase it?
Yeah, pretty much. So they basically had a higher equity stake in the real estate compared to the operating business, where we were able to keep more sweat equity. So we own 75% of the operating company between myself and my 2 partners.
So but the way the loan's set up, so is it 2 different small business loans?
Yeah, it's one loan, but then they basically, I think it's in the name of the property company, and basically, I might be wrong, so don't quote me on this.
Yeah,
this is where you do that editing magic. But basically, the loan goes to both businesses. And in total, between the 2, you would need to have 15% equity in our case, right? So if we're trying to borrow, simple math, $1 million, we need to be putting in, 15%, right? So if our total project was $1 million, $150,000.
Okay, so let's just say the real estate, you need 15% for that. Let's say you need $100,000 in equipment for the dog room. So you got to have 15% of $100,000 for the equipment.
Correct. Yeah.
Even though that's depreciating assets.
Correct.
They want, it's like, if I was to start up a McDonald's and I needed $250 to build the McDonald's, they want you to have 15% skin in the game.
Yeah,
pretty much.
Yeah, I just wish you could start a McDonald's for $250.
Right. But yeah, right.
I mean, I think the nice thing though is that while you might only need $15,000 for your $100,000 in equipment, you could also go still borrow another $50,000 of working capital. So it's kind of a cheat code in a way to be able to start a business with not a lot of money down. Is an SBA loan.
Okay. Wait, what do you mean by that?
Because you're borrowing money, that you could be putting in less money of equity to borrow more working capital of cash that the bank's going to give you to go start that business.
Okay.
Right. If you're borrowing $300,000 for your operating business, right, and you're only putting in equity of $45,000, but then of that $300,000, $100,000 of it is working capital. Does that make sense?
Yeah.
That's small numbers. These numbers, they don't necessarily make sense, but that's just a way of showing you that you could go borrow for working capital as well.
Right. The biggest piece of this is the 15% down for the real estate. That's the biggest chunk.
Oh yeah, man, the construction costs are crazy. Yeah, I mean, that's what we're going through right now. We've been going through permitting. We've got our GC bids and everything, and just everything costs more money these days. I mean, it's just crazy.
So I mean, it's such a good way to you now own. You amongst your investors, you own a commercial property and you own a business inside of it. Mm-hmm. It's really smart. Was part of this decision with the dog grooming, is it a cheaper startup? Were y'all, when you were identifying what type of business, what's the lowest, what are businesses that have good margins but also don't require a ton of startup funds?
I think for me, this kind of stemmed whenever I was actually in business school. I was already talking to my buddy, who I won't mention because he's still got a corporate job as well. But, he he's always known he wanted to do this, right? And so I've always seen his success. And so it's, again, I found a problem in the Rockwall area that there's not a lot of great options for dog boarding, grooming. There's lots of wait lists. It takes a month to get your dog groomed, right? And so I was just looking on the map and saying, man, there's not a lot of, stuff in this area. And there's, attractive demographics, land. I mean, like, it's a really growing area. Like, I think real estate's going to continue to do well there. And just people are moving there like crazy.
Yeah.
So it was just kind of, hey, do you want to go start this? Like, let's see where we could do this. And then we just kind of ran from there. Like, that's, again, find the problem, find the people, and then the money will come.
So you found the problem, you found what, so then at this point it's, I got to go raise the money.
Yeah.
So you had a minimum investment of 50,000. So you have 8 total investors. So how did you, I mean, I think a lot of people would say, well, I don't know people that, where do I even start here?
Yeah.
Like even for somebody like me who I'm like, I need to find one to do a flip. Like, what's the strategy here?
Yeah, I think, it's easy just somebody to chalk it up to networking, right? Because I don't think you just go and meet someone at one of those networking events, have lunch with them once, and then they're like, oh yeah, here's a check. Right. I mean, that does happen, but I think that's for people that have like really successful track records and, returns that they've already been given to investors, right? I think it comes down to over, the last 5+ years, right? Depending on where you're at in your career, maybe longer, right? Who are those people who have also been, successful? Maybe they're like the W-2 folks and they want to get, more creative. They want to get some investments that they actually really believe in besides the stock market, that get them excited, right? Like, are they interested in pursuing real estate? I think you've talked about on other podcasts, like, you guys are trying to create something where, people want to enter into this area, but they don't know how. Or maybe they just, they want to diversify their assets, right? So finding something that makes sense for them, not just like, oh, you need their money, right? So it's a win-win. I mean, for us, almost all of our investors, they love dogs. They love animals, or, one's a vet. One is, kind of in commercial real estate. One is a builder. One is, owns a company that does dog poop scoop business. I mean, like, you can see it's kind of in that area, right? Service business people, as well as like people that are in the real estate world, right? They understand what we're trying to do. And so I think, that was one part of it. But I think also most of the other investors either knew myself or the other partner who has the real estate experience, right? John, my other partner, I won't mention the one that's the operator because, as I said, he's still working at W-2. But John, my other partner, he's a proven entrepreneur, 15, 20 years of like doing his own thing. I can't remember if he went to college, but he's been just like a seasoned entrepreneur, has 2 or 3 other businesses, and people have wanted to do a deal with him. They've wanted to bet on him. And I like to think that that's the same for me. I have a little less experience, but, I got a couple of investors that, believed in me and believed in the concept.
Well, what's interesting about you, but I think this is really important because you don't necessarily you're not big on social media. I mean, you are from a personal standpoint, but
yeah, I don't build like my brand.
You're not building a brand, so everything that the brand you have built, which has been a good one, you've done just through efforts on networking. And one thing I've noticed about you, at least before kids, things change after kids, but you were always like, hey, let's do this, let's do that. Somebody like me, I'm like, dude, I just don't want to. I don't want to go get lunch. Like, I don't want to do this. I'm tired because I'm busy, right?
Yeah.
But you've always prioritized. I think you've known that was the goal, which is so important through college.
Sure.
And like you intentionally did things throughout college, and even when you went to Chicago, that was the goal, just to meet people. So I think if people listening, you want to be in real estate or want to start a business and they have to meet people, like, you've got to be intentional about those efforts. You have to be. It's something I probably regret a little bit of just.
I feel like you're doing it all now, though. I mean, you're the one that's asking me to go do things way more these days.
Yeah. My personality was always, I'm going to outwork everybody, but it's like whatever's in front of me. It's never been bigger picture. I mean, it is now. Things have changed for me, but if I could reverse some of the decisions I made previously, I would have put more of an emphasis on just that relationship and networking component of mine.
Yeah.
It's like when you grow up in sports, you're not worried about that stuff.
Mm-hmm.
You're worried about trying to be the best football player you can be, focus on yourself, lift the weights, do the workouts. It's not like, how can I help other people?
Sure.
So, but okay, so you went to, so you have this idea, you bring it to your investors, you pitch it, they're like, yeah, I'm all about it. And these are people who
Mm-hmm.
None of these were random people.
Yeah, one of them was a connection of one of our other investors. So that was the last one.
Okay.
But everybody else we knew. Yeah, I mean, we
But
had a
still, came
relationship.
through a connection.
Yeah, it was one of our investors' close friends.
Okay, so you raise the money. All right, so now how do you take the money you've raised, you apply that to the SBA loan. That's now your equity position. Mm-hmm. So then from there, what are the returns that your investors are expecting, especially on a commercial property?
Yeah, and that's exactly why we did two separate companies, because we tried to set up the return profile for each in a way that made sense for our investors from like a risk return perspective.
Because investors are not just going to give you money; they want. Yeah. I mean, they like you, but they want. It's got to make sense for them too.
Yeah, and that's where, like, in order to generate a return on the real estate for one of these types of deals, we will probably have to exit, right? It's not like we're charging, twice the amount of rent than, what the loan is. I mean, this market is not like that, right? So in order to generate a return on the real estate, we will either need to, cash out, refinance in the next couple of years, assuming we've created enough value, or we'll need to sell it. And the idea that we pitched to our real estate investors, I mean, all of our investors are invested in the real estate. We said, let's sell it and keep the operating business growing and just crushing it. And let's use that money, so you don't have taxable gains. And let's go roll that into the second and third property, right? Let's use that to scale in your next one and just keep doubling down, right? And they all like that. And then on the operating business, the way we did it, we kept a lot more of the equity. We own 75%, which is pretty generous. I mean, that's a lot of sweat equity in there, right? We're taking a lot of time to do this over the last year. It's going to really be like a 2-year journey to open.
You're saying you own 75%? You and your
myself and my two other kind of the general partners. We own 75.
So your investors make up 25%
for the operating, and then on the real estate side, we own 40%. They have 60.
They make up 60.
But for the operating business, the way that we made it a better deal for them was we said, until you have all of your money back, it's a 50-50 return, right? So on the operating business, we get $100, I get 50, or us as the general partners, we get 50, you get 50. Not us getting 75 and you getting 25.
Okay.
Does that make sense? Until they've made their money back, right? So, I mean, I think, towards the operating business, it'll probably be about, $250,000 going towards that from our investors. So we've got to pay back $250 before we really start to see that higher equity number. Okay. Does that make sense?
So once they're paid back, it then goes to the split?
Yeah, the 75-25. Yeah.
Okay.
But at some point, I mean, in order to grow the operating business, and this is why we wanted to make sure we kept, your equity is so important, right? I mean, if you're going to put in years of your life, you don't want to only have 10% of, what you create, right? Because you might need to take more money later. And then that's also just, I mean, that's where you're eventually going to be paying yourself from, right? Like, you're not going to be necessarily getting a huge salary, especially in my case where I'm not the operator. Right. So the idea is we have 75% now, but if this thing really does grow quickly, we might need to raise more equity later.
To scale.
Whether it's from our initial 8 investors who will get kind of a first preference, or you might say, hey, we've got 25% more equity we're willing to give up at a better valuation, like later on as the business is doing well. And we want that to be able to scale to our second, third, fourth, fifth location, right?
So eventually, whether it's 2, 3, 4 years, 5 years down the road, you would sell the property that you built to a buyer. So that buyer now owns the building, and you're a tenant in his building. But you still own you're still the dog grooming company.
Yeah.
So then you would take the proceeds from the sale, pay your investors back, hopefully make some, and then that's what you would use. You'd probably have to still raise more at that point.
Probably. Like, it depends on how much we were trying to do at that point. I think, the idea of kind of like, 1031 exchange, right? Like just being able to roll that to a second or third deal. that's probably what we'll hope most of them want to roll forward. They won't have to, but it might make sense. And, assuming the operating business is doing well, then we can either go buy a mom and pop shop. There's a lot of baby boomers retiring. Like we're thinking, hey, we can go buy an existing
and turn it into
our Rivers Dog Retreat, which is what the name of the company is. Got our website going up soon and groundbreaking soon. So excited about that. But yeah, that's kind of the not exit strategy, but scaling strategy. And then eventually, we could franchise it, right? We could do, we could exit to a larger brand. We don't know. It's just important to have options. So
the when you're building the unit, is it a strip?
It's going to be about a 5,500 square foot building. It's got about a 8,000 square foot turf yard.
So is it a multi-unit building or just
single tenant? Yeah, one building. Yeah.
Okay, so it's like a McDonald's.
Yeah, it's kind of ours happens to be on a corner, kind of off of a main road. We got a steal of a deal. I don't know if I'd call it a steal because we're the first one kind of along that commercial strip. But the HEB is going to be 1.5 miles from it. We think there's a neighborhood growing right behind us. So we're right there. But yeah, I think for a lot of these types of businesses, just leasing or getting into a multi-tenant building is great.
Wow, pretty cool, man.
Yeah.
So what? So going back to the real estate investment part. So what are the returns that the investors are expecting from that standpoint?
Yeah.
Is it a so for example, if I gave you $50,000 and you put that into the real estate, what are you telling them? They get their money back, but what are they making in the meantime?
Yeah. So on the operating company, we're expecting them to get money yearly, right? The property company, there might be small proceeds, but really we're just trying to make it more tax advantaged. There won't be
no interest payments.
Yeah, not really. The way the SBA works at least is they really want you to basically charge the cost of the loan as the rent, right? So it's hard to really create a huge return for your real estate without an exit or a cash out.
Yeah.
But I think, given our strategy, in 2 to 3 years, the idea is if you gave us $50,000, hopefully we're returning, $75,000 back to them that they could roll in.
So easy. That 50% return on your money in a few years.
Yeah. I don't know the annual rate right off the top of my head. Things have changed a lot since we did the initial pitch deck. Our concept has gotten a lot nicer, I will say. We're trying to be kind of a high end. But I think most of our partners, they were on, and I know it's a real estate podcast, but they were really interested in the operating side of the business. And I think on the real estate side, they had enough confidence in us that they weren't necessarily doing it to make as much money on the real estate. They believed in the operating business, which allows us on our first deal in the real estate to kind of tinker with what is the right concept here. And then on the next ones, I think we'll really start to make money on the real estate. And hopefully it's a better market, right?
So there's no payment you owe them for they're not requiring you to pay them interest on the real estate side.
Yeah, we didn't structure any kind of pref return or we kind of kept it a straight partnership on this first one. It doesn't work for everybody, but given we knew most of these people, again, no family. I don't have a single family member. John doesn't have a single family member. They're all network relationships.
Sure.
But yeah, we just said, hey, we're going to create our own operating agreements, subscription agreements, kind of did it, using a little bit of AI, using a little bit of just former agreements, templates. And we're keeping it pretty straightforward because we just want to be fair. We do business the right way. But you can do more complicated waterfalls or other stuff. I don't know if that makes sense for everybody on their first deal.
Sure. So your investors are really banking on this business booming, and that's where they make their returns.
Yeah, if we just said we're going to do one location, I don't know how many people would be that interested, right?
Yeah.
It might be more friends and family money if you do something like that. But I think we had a vision of, okay, how do we get this to be a 5+ unit type of business? And so the key for that for us, and this is where I think partnerships are really important, right? We each had skill sets to make this first one happen, but my operating partner, who's going to be the person working full time, he's going to be working in the business, growing the team, making successful, everyday transactions, building the customer base, all that. John and I are going to be working on the business. Like immediately when we open that first location, I can promise you we're going to be looking for the second, piece of land, right? So whereas if you go all in on your own, it's really hard to do that if you're running a business. I've done it. You do it, when you're a solo entrepreneur, it's tough, man. I mean, like you can talk about that too. Like how do you do that with a real estate deal? Like how have you been trying to grow, right? When you're finding deals and just doing it.
It's a lot of time. Yeah. I mean, you spend pretty much all night looking for deals. It'd be nice to have someone who does that for you and can run the business and you're just there to really broker it. So the way you've done it is smart, even if that means lower returns for yourself. Because I think a lot of people get caught up on, they want to try to make the most for themselves.
Sure.
And so that sometimes means more time.
Yeah.
But you've leveraged this to where you can scale, and it's like you might not make as much as you would, if you were doing this yourself. But when this thing scaled out, you're going to look back and go, this was worth every.
Yeah. It's also whether you're trying to create a job, like if you're trying to create a business, right? Are you trying to create a job for yourself, or are you trying to create something that ultimately is going to grow a lot bigger and get the returns? I mean, same thing with the real estate. If you do, one house flip at a time versus if you had a fund with a partner or something, you might make less on that first flip, but you were able to scale a lot faster. And honestly, kind of diversify your risk, right? Not every flip is a home run, right? You get a lot of singles. You might have one or two, and so if you have more deals, theoretically, you're on your risk-adjusted return. I feel like you could make more.
And I like how, your investors, they're going to make their money back from the operating and make their money back from
the real estate.
The real estate plus more.
Yeah.
So you
that's the hope. We haven't done it yet, but that's the vision.
That's the goal.
Yeah.
So, okay. I don't know how much you want to dive into the next one, but you are working on something else. Is the structure very similar to that?
So that was the one where I've kind of pulled in my other business partners. And the reason why I did that was, they've owned UPS stores. They're all successful entrepreneurs. They've done different businesses. And so it made the most sense because this venture is real estate heavy as well. We'll have to talk about it on a future podcast once it's kind of a bit more public. But I think the thing behind that one was I don't know how many dollars it's going to take. I needed partners who were willing to just kind of venture into a little bit of the unknown. It's, again, an operating and real estate venture. But on that one, it's a built-to-suit deal. We're not actually going to own the real estate. We've signed a lease. Okay. There's a lot of dollars at play. So that one, I was just going to them and saying, hey, I think I see a really great opportunity. And again, we can talk more about this in the future. But we don't have. But basically, like the structuring is that's kind of what you're getting at. Is like how do we start it? I was just saying, hey, let's kind of do this 50-50. That's kind of at least how it started. And on that deal, I only put up 25% of the equity on the cash side. Okay. I'm not deep pockets by any means. Young entrepreneur, so I'm getting some sweat equity on that deal as well because I'm the one that found it. I'm the one that has put in the efforts to actually make it happen. They're just financial partners and sharing a lot of wisdom. Sure. Right. They they'll pick up the phone, they'll give me their 2 cents, but they're helping me also from a credit standpoint, right? Be able to borrow a lot of money on it. And that's the other thing, right? If you try to borrow a lot of money, you typically need collateral, you need net worth. And on these leases, this is a built-to-suit commercial lease. They're going to build us about a $5 million building. And that's a lot of investment for this landlord, right? And so in order to do that, you have to personally guarantee on the lease. So not just my loan, I'm borrowing money, but I'm also going to be guaranteeing this lease. And a landlord looks at Ryan and my wife and they say, you don't have enough assets, right? So that's another reason you want partners, not just, operating experience or all those other things, but financial partners are not just for the equity front, they're also from a balance sheet front. Does that make sense? Like why I did that one? So I think we'll save that one for another episode. Yeah, I want to be able to share more. Yeah, because that's a whole different, it's similar, but
it's another way to do this.
Yeah.
And so we'll save that.
Yeah.
So I guess, let me ask you, I think a lot of people listening to this would say, if they're motivated, they'd go, man, okay, this is a really unique way to do this. What would all of this really came down to networking, I think, to an extent.
Yeah.
To an extent. What advice would you give to people who haven't been good at networking? Mm-hmm. How do they start now?
Yeah, I mean, I think before you think, oh my gosh, I don't have a network, I promise you do, right? Like that'd be the first piece of advice. One Saturday a couple of weeks ago, I just built a spreadsheet and I just literally listed out, top 100 people that are kind of in my network. I saw this on Twitter. It wasn't anything I came up with, but it was like, the top 5 people. You hear that quote of like, you become like the 5 people you spend the most time with, right? And it was like, okay, this is 50% of my time and investment. It's like my spouse, I've got my parents and my wife's parents on there, and then I've got kind of, it's my business partners. And so I kind of cheated. I had like 6 to 7 people on there.
Right.
And then you got like that next 10 to 15 people who are like, okay, these are the next 25% of your time, 25, 30%. And then you've got kind of like your next 25, next 50, right? And that's, lower and lower. And so if you do that type of exercise, you'll be surprised. Like, I think you have a much better network than you think you do, just because you don't go to all these networking events and stuff. You have people in different areas of your life, and then just look at it and like, okay, wow, Wesley, like, when's the last time we got together, right? Oh man, we haven't had lunch in a couple months, and then bam, you just reach out and you're continuing to build on your existing relationships rather than thinking, oh, I've got to start from square one.
Okay.
So that's one tip I would give. And then the second thing I would just say is like, have like win-win like mindset when it comes to this, right? You can't go out to these things and just be like, I got to raise money, or, trying to sell my business, right? No, what's in it for them as well, right? It's a win-win. How can I introduce them to something? How can I, support their business or real estate, right? Venture, whatever it is, right? And over time, like, doors I think they open.
Yeah.
Right?
Yeah. Do you think it's, if you know somebody or you do this exercise and you pull up a bunch of people, you're like, oh, okay. One approach I've heard is don't necessarily go in targeting those people in your sphere, but say, who do you know that could make sense for this? And then they connect you.
Yeah.
Or they might say, I am,
Sure.
And so it's more of a soft approach to, because I'm thinking about some people I know that they've seen what I'm doing, and it's just going to them and saying, hey, look, I'm really trying to scale.
Yeah.
This is what I'm trying to do. Who do you know that could help me with this, or would be interested in investing in real estate?
Yeah.
Or investing in dog grooming or whatever. So, well, cool. I learned a lot on this episode. This was fun.
Yeah, man.
Appreciate you coming on. How can people find you?
Yeah, like you said, I'm not huge on social media. I think part of it's just, it's not been the way for me to grow my, business. I mean, I definitely was on it more in college when I was starting, but anyway, they can find me, Ryan Snitzer, on Twitter, Instagram, hit me up on LinkedIn. Would love to chat with people that are, trying to do something like this. I think, paying it forward has always been, really big for me. I mean, I've had so many people pour into me, and I love doing that for others. So feel free to reach out. But over time, I hope to create more of a brand. I don't know if I'll do the podcast thing or not, but, I really admire what you're doing, Wesley. And I think it's just going to have a multiplier effect, right? Like, I mean, you're building a network even just through this podcast, people that come on and, people that see this, see other videos you've done. So yeah, hit me up on LinkedIn, man. Or wherever.
Love to have you back once we get some more down the road on this next one, because I learned a lot on this one. So glad you came, man.
Thanks, man. Appreciate it.